The fire sales have started. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, a major crisis is unfolding in the commercial real estate market as sellers are now holding fire sales to unload their commercial buildings. The question we're asking is, what do they know that everyone else doesn't? Well, we're going to show you exactly what they know and why we think that commercial real estate prices could crash by more than 20%. And we're seeing further signs of lack in demand from consumers. And on top of that, even broad-based demand around the world is starting to fall. We have a report today that came out that many said could not happen, and the numbers are shocking. It just validates what we're seeing is a major downturn in global demand. And we're also seeing the major investment banks are betting big on the outcome of the debt ceiling. We're going to show you who the big winners and the big losers could be. Let's go to the Wall Street Journal, where we picked today's story up with a headline: Rise in distressed sales signals new chapter for beleaguered office market. Now, this is real important to understand because when we look back in history and we see fire sales, you may remember when some banks started dumping mortgage-backed securities and other banks were like, hey, why are you selling this at a discount? We'll take all that you've got. And then next thing you know, the entire mortgage-backed security market absolutely tanked as the housing market also fall down. And what do we see? The banks that were holding the bag took big losses here, and now we're seeing this same setup in the commercial real estate market. In recent weeks, Blackstone sold Griffin Towers office complex in Santa Ana for $82 million, or get this, about 36% less than the firm paid in 2014. How about this? The tower at 350 California in San Francisco, valued at $300 million in 2019, is expected to trade at about $60 million, or roughly 80% below that previous valuation. And these indeed, my friends, are fire sale prices. Now, why some people want out, others want in, but we kind of know how this goes. So the question is, what do these companies know? Why are they so eager to take a major loss? Well, we'll show you here in a moment. Now, the uptick in troubled office building sales indicates that more owners believe that weak demand is here to stay. The volume of distressed office deals is expected to rise even further in the months to come as billions of dollars worth of mortgages need to be refinanced. So we're seeing a couple issues here. One, potentially too much supply in terms of office space on the market. We know the work from home and the hybrid work schedule have really sent a lack of need for space. The other question that's going to come up is, can the banks even refi these properties, particularly if we're seeing the value of them plummet? It could put a situation here where maybe leaseholders actually turn to default. But let's see if the banks can handle this, and the answer is no. Here we're looking at the net percentage of domestic banks tightening standards for commercial industrial loans to all size firms. That in blue. Remember, this is tightening when it's over that horizontal black line. That blue line is above that. Here we can see commercial real estate prices for the United States. Now, we don't have a lot of history on real estate prices, but normally look at this. We can go back to the global financial crisis. We see that commercial and industrial lending standards were tightening, and look what started to happen. We see the red line go down. Now, it doesn't start to contract until it hits the recession. It's kind of right here in the middle, and by the time it's over, you see a drop of more than 20% in commercial real estate prices. Now, as soon as banks started easing standards off, what happens? Prices came back up. Of course, we know the Fed lowered rates, did quantitative easing, and we can see the prices kind of continue to rise, as showing on a year-over-year rate of change. And now we can see, look what's happening again. Now, why didn't it happen during the pandemic? Well, there was just too much stimulus money. But now look, we're seeing lending standards tighten, which suggests there could be a major crash in real estate prices. So some people are looking to get out ahead of that, because potentially now it could be worse than the global financial crisis without having people using these buildings, when we find out that there is just a lack of demand and that the rent that the building can command is far less than what it would years ago. Well, that means prices maybe even could drop further than I think, of more than 20%. Listings of office buildings for sale are also rising, again adding the narrative that more supply is coming onto the market, perhaps will even further depress prices as office inventory is growing and investors now want out. And sales at markdown prices likely will put more downward pressure on the office market, not only by establishing lower prices for comps, but by undercutting their competitors' rents, as market participants are suggesting. And we know that that's going to happen as buildings that have lower rents. We're going to see companies economies that need space move, and we're going to see buildings that are overpriced forced to compete, and if they can't, that means prices are coming down. And the banks, again, you got to remember that a lot of these small and mid-sized regional banks did a massive amount of lending to the commercial space, and they're sitting on all of these loans. That may mean they can't refinance and facing a potential large wave of defaults. And where will we see that? Well, we'll see that in the delinquencies first. And the delinquency rate of home office loans that were converted into commercial mortgage-backed securities increased to 2.77% in April, the highest rate since August 2019. Now, you remember August 2019, you go back and look, the Fed had just started cutting rates. The economy was slowing down ahead of the pandemic. So what we're seeing is now an uptick in delinquencies. And as we all know, eventually delinquencies lead to defaults. The banks are in absolutely no position to handle that, especially when we turn and see consumer demand. Contrary to the retail sales report that just showed slowing demand, we're seeing even further evidence that consumers are tapped out here, and that means further job losses and, of course, a more open office space as people just don't need to go to work. Target earnings are squeezed by slowdown in sales as shoppers are cutting back on everything. And here we can note that comparable sales, those from stores and digital channels operating for at least 12 months, came in flat for the quarter ending April 29th. That was slightly lower, of course, than the previous quarter, 0.7% rise. So here we see a flat quarter as shoppers continue to pull back on some discretionary purchases. Now remember, we said this was going to happen. The first place people stop spending is discretionary. Here we're seeing a Target. They're validating everything that we now know to be true, that the economy is indeed slowing down, and shift their spending to essentials such as food and household goods. Of course, we know inflation being the big problem there as interest rates and prices rise and wages aren't. Sales of food and beverages, Target noted household essentials and beauty remain strong, and that was a good thing, but discretionary spending still a problem. And now, as we talked about before, inventory, as they say, we continue to contend with significant headwind caused by inventory shrink, building on a worsening trend that emerged last year. And of course, that could lead to less profits, as we know that Target and a lot of other retailers are just desperate to clear out this inventory. And at the worst possible time, they have a massive amount of inventory going into a slowing economy where we're seeing an uptick in initial claims. Of course, we'll get the data tomorrow and see what's going on with that. But the outlook here is just rather grim. But it's not just, the U.S. consumer, we're seeing a slowdown. It's the broad global economy. Now, I want to show you this headline from yesterday, and look at this report. It says, oil gains as traders weigh U.S. debt talks and China's demand. And remember we talked about this, and that, of course, everyone's believing that there's going to be a big surge in oil prices after, of course, the debt ceiling is met. And we showed you historically it was only because factory demand was increasing. The notion that suddenly the debt ceiling is resolved and oil prices jump $10 or $15 a barrel is rather unrealistic. As West Texas Intermediate Futures, this again from the story yesterday, and then I'm going to show you the data today, erased earlier losses and rose markedly above previous session close. And why did that? Well, the belief was that global demand will climb more strongly than previously estimated this year as China's post-pandemic recovery surpasses expectations, even though the data out of China said otherwise. Yet some banks were cutting growth forecasts. So the question then is, what happened today? Well, before we get to that, wouldn't you love to know when crude oil is trading near a historic low based on our computer models? Well, that will tell you when to buy, when to sell, and of course you want to be buying at the bottom. CTA-Timer Pro tells you that. It's $30. Link in the description below. When you see those big negative signs show up, and we give you some notes in our report to show you, where you can see this. When we see something, we do a weekend update. It says, look, put these on your watch list. You want to start buying low. We'll get the report that shows you when things are actually low, because right now it looks like crude is going to head a whole lot lower because global demand is falling. Look at this crude oil inventories. We get this today, up 5 million barrels after up 3 million barrels last week. Distillate stocks now holding even, and a small, roughly small bill or draw at 1.381 million on gasoline, small relative to where it was last week. But all we've noted is, of course, a lot of the gasoline could be from a lot of the holidays, and we're working through that. But the fact that we're seeing these big crude builds suggests that, of course, the global economy is slowing. And one thing that doesn't make a whole lot of sense here is why we're still draining the Strategic Petroleum Reserve. The Biden admin proclaimed their intent to buy 3 million barrels and start refilling the SPR this week, but yet they drained 2.4 million barrels, the seventh straight weekly drain, now at 11.993 million barrels over a 7-week period. And my friends, I don't even have words to explain why we're doing this. It doesn't make any sense to me. But what we can see is at some point oil will fall enough. The question is, will the government buy it? Will they actually come in and put support under the energy market? That will remain to be seen. But what does crude oil suggest in terms of that broad slowdown into retail sales? Well, it tells us that demand from the consumer is going a whole lot lower than the government is reporting. And here we can see advanced retail sales in red against crude oil prices in blue, that being West Texas Intermediate, both on a year-over-year rate of change. And we can note when the blue line starts heading down, it tends to lead the red line, red being retail sales. And we note that we can see that now. Crude oil is telling us, the energy market is telling us, look, the slowdown the Target is telling us about, the one that Home Depot is telling us about is outright real. But one place that doesn't buy into that, well, is home builders. They think everything is getting better. As U.S. housing starts rise and a sign home construction is stabilizing, but do they have it wrong too? Well, applications to build a proxy for future construction fell 1.5% to an annualized rate of 1.42 million, while elevated mortgage rates and affordability concerns remain headwinds for housing. A lack of inventories could support building activity over time, and that's kind of what we're hearing now out of these home builders, is they're actually getting rather optimistic, and I think they're getting optimistic at the wrong time. As builders are taking advantage of a historically low supply of existing homes for sale, and some are offering financing incentives to ease affordability constraints amid budding demand for new homes, which explains why homebuilder settlement currently stands at a 10-month high. But that could be wrong, because here we can see new one-family houses sold in blue against a 4-week moving average of initial claims. And what we can note is as people lose their job, and again, this is just going to make perfect sense, they don't buy big ticket items like homes. It makes absolutely perfect sense. And so what should we see in this chart is as initial claims rise, homes sold falls. And we see that in the 70s, we see that in the late 70s, we see that in the late 80s into early 90s, we see that in early 2000s, but not as much in the 2000s. Again, the baby boom boomers really were driving the housing market. We see, of course, the global financial crisis, homes sold outright crash. Here we're starting to see it again. The question is, what do you think? Do you think there's enough demand that the builders can get through this? Or do you think we're going to see perhaps a repeat of the 80s or the global financial crisis where we see an outright crash in home prices? I'd like to know what you think about this, because now let's talk about the debt ceiling and why some companies are betting big on the outcome. As debt limit talks intensify, as Biden set to depart for Japan, as we noted, this trip would be kept short because he will be back, as McCarthy said on Wednesday, that we do not have a debt default, suggesting that we're going to have a deal perhaps made, and that is a good sign. That's what we want. Neither side really wants to see a debt default. As we've noted historically, it's always used as a bargaining chip to push things to the wire to get whatever one side wants over the other side. But what we're strangely seeing, or at least what appears to be, investment banks making bets on it, or at least making outrageous claims suggesting that they're positioned in extreme matters. Here we see PIMCO saying that debt cap fear may push bill yields to 10%, and that would be a suggestion. If you're short the bond market, that would be great news. Maybe PIMCO is massively short here, trying to get other people to buy in or take out their positions. Its fear is going to be exacerbated to the tune of hundreds of basis points, if not more, in T-bill yields. The reality here is there's absolutely no truth or any evidence to support that that is even possibly going to happen. Let's go back to 2011. Here we can see that yields did rise. This was in July. You see where the blue line went up here. That August was where the debt ceiling really came to head. The negotiations went down to the final wire in late August, and what happened? Yields did not continue to rise, when in fact they actually fell back down and made new all-time lows. Meanwhile, JP Morgan says markets are right to bet on U.S. rate cuts, the case we've been making for quite a long time here, that rates are more likely to come down than go up, as they favor U.S. Treasuries in siding with swap traders who predict the Fed will execute a policy pivot as soon as September to counter slowing growth. but the U.S. Central Bank has repeatedly pushed back against this notion, as it always does, raising the prospect that such bets may backfire if officials maintain a restrictive stance due to subdue inflation. We know inflation is coming down, but we also know the yield curve has been predicting and suggesting and trying to tell the Fed it needs to cut rates. Of course, we've noted that in our show, that part of the problem the banks are facing is due to the fact that the curve is inverted. And at some point, if the Fed doesn't cut and try to fix the inversion in the curve, then bad things are going to happen. Perhaps it's going to be a crash in the commercial real estate. Perhaps it's going to be more bank failures. Perhaps it's just going to be an outright collapse in demand. It remains to be seen where it starts first. But what we can note is that at some point, the Fed cuts. And when they do, it's not going to be a little bit. It's going to be a rapid move on the way back to zero. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.